Hey there, thanks for tuning in. Welcome to Investing in Germany. And today I want to dive deep into the Emerging Market Index. So, Emerging Market Index is also really popular in the ETF community in Germany because it is part of the 70-30 portfolio. In 70-30 portfolio, you're investing 70% of your money in the developed economies like the MSCI World Index and 30% into an emerging market index or the developing economies like China, India, and so on. So, this is really popular because on one side you are investing quite heavily onto the developed economies where the political stability is there and also the currency stability is also there, and therefore there's not a lot of volatility in the developed markets. And you also want to get the high growth effect from the emerging markets, which is already really volatile because of the political uncertainties and also from the currency uncertainties. So there's a lot of volatility going on in the emerging market. Therefore, in 70-30 portfolio, you have reducing this volatility by investing less in the emerging market and also getting exposure towards high growth companies like you can see in Alibaba or in India Reliance and Infosys and so on. So you get both aspects, a very long stability and really proven investment in the developed economies and also a lot of growth and also a bit more volatile in the emerging economy. So this is something really popular in Germany ETF portfolio, 70-30 portfolio. I already reviewed the MSCI World Index, which is covering the developed economies. So the link to the video will be here on the description, also here on the screen. And today let's cover the emerging market index and let's dive deep into it. And finally, we'll also find an ETF where you can invest in very cheaply in Germany. So let's dive deep into it. So here I'm in the MSCI.com website where we can go ahead and have a look at the fact sheet of the index itself. I would always recommend you to go ahead and have a look at the index provider website for the details of the fact sheet and so on, because the index provider are obligated by the regulated body to maintain all the data up to date and easily available for us. If you are relying on a third party website, they might not update up to date. So they might not be updating the documents up to date. So that is an inherent risk of going to a third party website. So I always recommend you to go to the index provider of the ETF provider website and have a look at the fact sheet data there. So let's go ahead and find the emerging market here. And searching it in the real good search engine here, you can go ahead and find the second option, index search. And I'm pushed into all country world index, but it doesn't matter. We are also already here in the MSCI Emerging Market Index. So in Emerging Market Index of the MSCI, they are tracking 24 countries. So MSCI is categorizing 24 countries around the world as an emerging market. And they are also splitting it into different continents. So you can see America, we have the Mexico, Brazil, the big boys of the emerging market from the Americas. And EMEA, we have Czech Republic, Hungary, all the Middle East countries. And also here from the Asia, we have the China, India, Philippines, Taiwan, and so on. So these are the 24 countries which MSCI categorizes as an emerging market. So therefore, if you are investing in an ETF, which is tracking an emerging market, so you'll be investing in the companies which are located in these 24 countries. So that is all about it. And you can see here the fact sheet of the emerging market index. So clicking into it, you will be directed towards the fact sheet of this index, which will be up to date most likely. Let's have a look. It's updated on 28th of April 2023. I would say it's more or less okay. Yeah. And you can see it's 24 countries, emerging market, and they are investing or tracking 1,377 constituents. In other words, they are tracking 1,377 companies located in these 24 emerging markets. And here they're also giving you some comparison between the emerging market, developed market, and all country world index, and which we covered already. So you can see that the emerging market is underperforming the world market or the developed economy. So the question would come here, why should you or we should invest in emerging markets? So you should also consider what happened in the last decade or so, because in the last decade, there was a lot of money printing happening in the developed economies. And therefore, there was a lot of liquidity, and therefore the number of companies in the developed economies were doing really well because there was no shortage of money and people were really investing in it and so on and so forth. In emerging economies, you can see that a lot of devaluation happened in the last years, and therefore you can also see here that they are underperforming the world index. So whether it's good or bad is something that we cannot really expect, and we cannot also really forecast what is going to come in the next 10 years. So if the emerging market is going to do really well because of all the demographic activities that is being done, a lot of middle class people are in the emerging market, and the population of the emerging market is going up, and then population of the developed economies is going down, which is also a negative for the MSCI World Index, for example. So you cannot really predict what is coming in the next 10 years or next 20 years. So therefore, it is always better that you invest in both the developed economies as well as in the developing economies. So therefore, something that the portfolio is really statistically much more sound investment methodology for investing in the ETFs. So the dividend yield is 3.33%, and then PE ratio, I would really skip the PE ratio here because the PE ratio is of no value for an ETF, because see, in 1,377 stocks, I'm pretty much sure that a lot of companies are loss-making companies in the emerging market. So if the company is making loss, then they cannot calculate the PE, and therefore they skip those loss-making companies out of this PE calculation. So therefore they are taking only the profit-making companies from the 1,377 stocks, and then they are calculating the PE, which has no value in my sense. And I would not really focus on any time into this PE value here. So let's skip that. So what you can see here is the top 10 constituents. So it's really good, I would say, because there's a diversification here, because Taiwan, China, Korea, India, Brazil, if you compare that to the MSCI World Index, which we covered in the last video, top 15 stocks was coming from the American stock market. So there was no diversification. There was more or less the American index. It was like an American index, right? Here, it's a lot of diversification happening. If you look at the country weightage, it is also much better compared to the MSCI World. The MSCI World Index is 70% of the index was tracking the American stocks. Only the rest 30% was tracking the other developed economies. And here you can see that the top is the 31.38%. And then there's a lot of equal weightage given to a lot of countries here, I would say. And therefore, I think it's much more diversified in the right sense for the ETF here, or for the index here for the emerging market. And from the sector weight, they are more concentrated towards the financial sector. If you consider that to the MSCI World, there's a lot of weightage given to the technology stocks because of the Facebook, Alphabet, and so on. And here it's more into the financial sector. Whether it's good or bad doesn't matter, because we are investing in 1,377 stocks, and that's a diversification overloaded for me. So whatever happens, it doesn't matter because it's hugely diversified, I would say. So this is the index as such. China, India, Brazil are taking the top spot here. And then South Korea is also there, and Taiwan. So it's a really good index, I would say, for tracking the emerging economies, where there's a lot of opportunities coming in for the growth perspective in the next decade or so. So let's find the cheapest ETF available to invest in this index. So for this, I'm using Just ETF. Just ETF is like a ETF search engine, and there are quite a lot of other search engines available in Germany, but I like Just ETF, and it's also available in English for you guys, so it's much more easy. So let's go search the ETF. The first topic that you have to do is to select to be an MSCI. And then, as you know, I like to have a bit more fund size, above 500 million. In better case, I would like to have it this in the billions. So for now, I select above 500 million. And I also like to have an accumulating, because my runway of investment is quite long. And I also recommend to my friends, or suggest my friends, to go ahead and invest in accumulation, so that they don't have to deal with the dividends and then play with the money and do something else. Rather, you can let the fund manager to go ahead and invest the dividend back into the stock and have the compounding effect coming into you automatically, right? That's a really good aspect in investing in ETF. Accumulating, and then I also need to select the emerging market index, and then right away I'm given only 5 options, from which it's much more easy to navigate through and find the cheapest option. So for this, I use the TER, the total expense ratio. So the smaller it is, the cheaper it is. So 0.18 is the cheapest option for my conditions or requirements, and out of which I will take the iShares, much more popular company from the BlackRock. BlackRock is one of the biggest asset management company in the world. So it's much more safer, I would say. So here You get all the details here, but then, as I said, I always go for a fact sheet, and you can get the fact sheet directly here, linked from the iShares and updated on the 6th of April. It's quite new, I would say, 1 month old around. Maybe the May version is roundabout in the corner. So if you wish to have a look at the May, probably you can have a look in the next couple of days or so. Yeah, if you see here, it is IE registered in Ireland. When it comes to investing in emerging market, you have to be really careful here, because emerging market has its own risks of political stability or currency stability and so on. Therefore, it is always better that you invest through a regulated body, so that you don't have to deal with a lot of uncertainties and volatilities and all other issues that comes out with investing in the stock market in the emerging market. So here, this is UCITS, so this is regulated ETF in the emerging market, so it's really good. And 0.18%, which we saw, and this is also done in optimized physical sampling. There's also fine accumulating. It's all the same what I was selecting for. That's always good. And what I see here is one red flag. So number of holdings here is only 914. So they have reduced by 30%, like more than 30%. They have reduced. They are tracking only 70% of the index. So therefore, one of the reasons why the TER could also be low for them. So this is quite interesting. And the top 10 holdings, they start with their Taiwan Semiconductor, and then they start with another iShares MSCI China ETF. So they are investing. So here you can see the ETF is investing in another ETF. So it is a fund is investing in another fund, which for me is a no-go, which for me is a red flag, a big red flag, because investing in another fund, which means that they are making 2 times the money. So they are just trying to make more money for themselves, and they are not really optimizing it all along. So they are not optimizing it. So it's not so good sign, I would say. And again, there are and then you can see another iShares fund. So I would say we have to skip this, even though it is the cheapest option, and a lot of billions are poured into this. Around how much billion was it? Yeah, 1.7 billion, something like that. I would not invest in it, because they are investing in the fund of fund. And interestingly, they are also underperforming in tracking. So they are tracking only 27.26. So if you compare that to the fund itself, index itself, it was tracking around about 31.38. So they're underperforming, or the delta is 0.4%, like 4%. It's not a really good fund to invest in. So I would skip this. If you're liking it, you can go ahead and do it, but this is not for me. On the next best option, I see Xtrackers. So let's have a look and see what surprise we have there. Okay, so it's in Ireland, 0.18, and their direct replication, that's good. And the fund is 4.81 billion, that's really good. And how old is this document? 31st of March, it's fine, I would say. It's not so old. Maybe the new document comes quite fast now. And you can see here Taiwan, Tencent, Samsung, Alibaba. So they are not investing in another fund. So this is a good sign to start with. And they're also more or less tracking the China closely, like 2% delta. That's fine. That's much better than the 4% what the iShares was doing. So I think this is a better investment option compared to the iShares for the same TER ratio, even though they are also not doing a real good job in tracking. But this 2% is okay, because investing in emerging economies has its own risk. And then they are tracking 1,416 stocks. So if you compare that to the index, that index is 1,377 stocks, and here they are tracking 1,416 stocks. So are they investing in more companies? More likely not, because they will be investing a lot into different class shares. If you remember, in Berkshire Hathaway, one of the biggest ethical company around the world, they have 2 different stocks for the same company, the Class A shares and the Class B shares. The similar goes also to the Alphabet. They have Class A, Class B, Class C shares. So if they are going to invest in all the different classes, then number of stocks will increase, obviously. So this is something that is known already in the ETF world, and I would not be really putting this as a red flag in this scenario at the moment. But this is something that we have to really close watch. what really came into my mind here is that the Brazil was at the last year. Yeah, the Brazil was index 0.85, and here they are giving 0.92. So they are investing more and they are investing less in Infosys and HDFC. So this are something you can see that a lot of deviations coming in from the ETF index and the ETF. So this is something that you have to really keep a watch on. And if you are investing in this fund, you have to really keep an eye on how they are tracking the index of the long-term basis. So therefore, this is also something, a sort of a small, I would say, a yellow flag, not a red flag. But you have to really select what is fit for you. So this is what it is. So it's really complex. If you see, the investing in ETF is really complex. If you are really diving deep into it to find the right ETF for you. So therefore, I would really say that you have to really dive deep into the index and then dive deep into the ETF providers and also the fact sheet and where they are investing in and all the other fun stuffs of investing in ETF. So thanks for watching and see you in the next video.